Good day, Market Chameleons. Everyone joining for the first time, thanks for coming by and checking out the Market Chameleon show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. All our shows are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. How you doing, Dima?
Good morning, Will. How are you?
Great. Today we're going to talk about how to screen implied volatility skew by expiration, correct?
Yep. Let me share my screen here. And what we'll do is first, let's go to the page that we're going to show an example, and then we'll discuss it. So I'm going to go under Options, Main Menu, and if you scroll down, it's under Screeners. Under Screeners, Options by Expiration, we're going to click on that, and this will take us to a screener that lists the stocks that are available for trading options, that have listed options, and then it provides us with statistics and analytics on the expiration level. So for example, if we just put in SPY, type in search SPY, you could see that SPY shows up a bunch of times. And the reason for that is it has different expirations and for each of those expirations, we calculate analytics specific to that expiration. So, that the money implied volatility, for example, August 5th expiration could be different than for August 11th expiration or October 17th. So this way we could compare the different implied volatilities. We could see the changes in the implied volatilities, the volume, open interest, and so forth. So the idea behind this screener is that we get to analyze it, the option specific to an expiration. Now, I'm going to keep it for now in SPY, and we come over here. We have these different tabs, and we have one that's called Skew. And what this skew table does is it tries to create a metric to get an idea of the vertical skew or vertical implied volatility skew in that expiration. In other words, if we start out at the money implied vol, right? Let's say over here there's an at the money implied volatility, which is the implied volatility for the option that is strike price equal to the stock price, right? So that's at the money. And when we look at the options within an expiration, well, the implied volatilities could be different, right? On different strikes. So as you go up in strikes, the implied volatility could increase, it could decrease, it could stay the same. So if it was the same on every strike, we would say that the implied volatility is flat. There's no skew. So if, for example, August 6th, if the implied volatility on every option is the same, every strike price it's the same, well, we'd have a flat skew. Meaning, like if you have a strike of 100, that's at the money, 100 with 10 if the implied volatility is 10, and if we look at a strike price of 110 and the implied volatility is 10, if we look at a strike price of 90, the implied volatility is 10. Well, if it's all the same on every strike, there's no skew. But what if there is a skew? We'd have to go to the options chain and kind of observe it. We'd have to look through and see if they're increasing, decreasing. We could draw a graph to visualize the smile, like if the shape of it. But in a table, that would be difficult to do. So we need some quick key metrics to compare it to. So in this instance, what we do is create a metric looking at a 25 delta call and a 25 delta put. Okay, so 25 delta call is an upside call, right? That's a call that's out of the money going to the upside. A 25 delta put, that's an out of the money put to the downside. And the idea there is, well, is it increasing or decreasing? So if we ran a flat skew, right? Let's say we first run a flat skew of 13.3, and then we found the 25 delta call and said, okay, well, here's a 25 delta call based on a flat skew, but what is the actual implied volatility, right? So now we know, if it's 13.3, then there's no skew. But let's say it's below or above that, well, then there's a skew. So if it's above it, all right, that means it's higher. If it's below it, it will be below that, the money. So let's take a look at, for example, August 6th. If a flat skew would imply every, option would be 13.3. But here, what we look at is if we find the 25 delta put, the actual implied volatility is 9.5% higher, right? So it's almost 10% higher than 13.3. So like a 1.3%, let's say high, it's like 14 with something, 14.3. So that's telling us that the implied volatility going to the downside is higher. It's skewed higher based on a 25 delta put. What about the other way, right? What about if we look at an out of the money call to the upside and we find a 25 delta, and you can see we're comparing this to at the money. We want to see, is it above or below the at the money? So this one, 25 delta call, is lower by 11.5%. And this is telling us really kind of, if we had to visualize, I mean, we're only using like the 3 points, but if we had to visualize what it looks like as what it would look like if we're moving from at the money, that the implied volatility is sloping higher to the downside, sloping lower to the upside, indicating if the stock is going to increase, the expectation is the implied volatility, or the volatility of the stock will decrease. If the markets or SPY falls, goes lower, then the implied volatility or the volatility of the stock is expected to go up or increase from the at the money projections. Okay, so that's quickly, we could see now how the skew lines up for each expiration, right? We could see that if we, and these are right now organized going from the most closest expiration, closest to expiring, to the longest term expirations. And here we could see that even just looking at the downside puts, that as we go out, the skew gets steeper and kind of levels off over here, on the around a 20% increase in the implied volatility to the 25 delta put. To the upside, we could see that the implied volatility decreases at a higher rate as we go out further and further in time. Okay. Now we kind of have this idea of what the skew in SPY looks like for particular expiration, and we could just compare expirations down the, because I isolated it to SPY, I typed it in here. We could look at just SPY. Now, what if we wanted to compare it across different stocks for an expiration. Let's just say we were interested in a certain expiration, let's say September 19th, right? So we could come up here and say, well, filter out everything that's September 19th. I'm going to take off SPY for now. So now what we have, let me sort this by, I'm going to come over here and let's sort this by total volume. Okay, so this way we see the stocks with the highest option volume. And then let's come back to the skew tab. So here now we see SPY, IWM, NVIDIA, Amazon, QQQ, the most active traded options in September 19th expiration. And we could see how this skew compares to each other. So like, for example, SPY, the skew to the downside increases at a faster rate than in IWM. To the upside decreases at a faster, at a steeper percent. Here, like for example, Amazon, the downsides, it doesn't have such a large downside skew, right? It's almost flat, a 2% increase relative to SPY and 18%. And to the upside, there's only a 3.4% decrease in implied volatility relative to SPY at 18%. So Amazon looks like a much flatter, there's still a skew, but much flatter than SPY, right? Like you're comparing 18% versus 1.7%. We could compare QQQ at a 14.3% skew versus a 18% in SPY and 17% down to the upside, which is similar to the SPY. And so this lets us quickly compare skews across expirations and filter out particular skews. Now, what if we wanted to compare the 25 delta versus the put versus the call? So let's say we do, instead of comparing it to the put to the at the money and the call to at the money, what if we wanted to compare the put implied volatility, and is it higher or lower than the call? By how much, right? So what we wanted to do is one metric. So here you could see that the 25 delta put implied volatility is 44% higher than the 25 delta call in SPY. In IWM, it's 23.5. Here, it's almost flat. So look, in Tesla, the put and call are almost the same. That's what it's saying. The implied volatility in the put and the call are close together. The put is slightly higher by 1%. Okay. Here, it went the other way. In UNH, the put, so the put and the call here, the put is higher than that the money, and the call is higher than that the money. So the volatility smile kind of looks like a smile increasing to both sides, but the call actually is increasing at a faster rate, 3.1 versus 2.2. That's why we have, if we just compare put versus call, we got a negative 0.8%. Okay, so this kind of gives us an idea of the out of the money comparison of the out of the money calls versus puts, bullish calls versus bearish puts, right? And you could have a reverse skew, like a -1. Here's like a -1. Let's see if I could find any, for example, here in gold, right? So gold, GLD, which is the gold ETF, we could see that the implied volatility actually on the downside put is lower than that, the money. And on the upside, bullish call, it's higher. So indicating that gold if it goes down, maybe the volatility will decrease, but it could go up where the volatility increases. So it kind of makes sense, right, with gold, because if there's a run to safety or inflation, that it could go up faster than potentially go down, right? So that's kind of, and it's not a very steep skew. We're talking about only 1%, 4.5%, but it kind of gives us that. And here's silver. So silver is similar too, right? That if we go up here, that the implied volatility or volatility of the security may start moving faster at a faster clip, which is much different than how SPY or S&P 500 is expectations are built in. Okay. And if we wanted to just, let's say for September 19th expiration, let's say we wanted to look for things that are just high in volume, maybe like over 20,000 contracts. Let's see what we get. So now we filtered it to 50 out of 32,000 different possibilities. We now filtered it down to the top 50, or the 50 that meet this criteria, over 20,000 volume. And we could even see, we could sort this like this. So let's say we sorted it by 25 delta put versus call. So you could see SQQ, JD, these are the ones where the put is actually, the implied volatility is below the call, right? IV of the put is less than the IV of the call if it's negative. If we wanted to see the other way, we could sort it. And these are the where the put is much higher, or the higher than the call. So the put IV is 114% higher than the call IV. So this is a really quick way to use this tool to start screening for your initial research on implied volatility skew by a particular expiration. All right, well, I'm going to stop right there and throw it back to you.
That was great. Way to end the week, D. Great webinar. Lots of chameleons are coming back from vacation and on the show live, which is great. Thanks as always, my friend.
All right, thanks everyone for joining, and have a great weekend. Stay safe out there. Hope you have a great trading day.
All right, D. We'll see you Monday, buddy. Thank you. All right, everyone. Thank you for joining the show. Remember to like and follow us on all the social platforms. Remember to thumbs up if you're on YouTube. Hit that subscribe button. Always great to get alerted to the show. Everyone have a great trading day, a great weekend, and we will see you Monday. Have a great day. Bye-bye.